All right, takes us to our talk of the tape. Second half for stocks and whether a significant broadening might be in the cards. Let's ask Liz Ann Sonders, Schwab's chief investment strategist, back with us. Good to have you back.
Nice to be here. Thanks.
I took a riff off of, what you were telling our production team today about this tale of two markets, right?
Yeah.
Resilience at the index level, but considerable weakness, you say, at the individual stock level. Expand on that and whether you think it gets any better as we make the turn.
Sure. So using the NASDAQ as an example, admittedly an extreme example, but illustrative nonetheless, is you've had no more than a 7% maximum drawdown at the index level for the NASDAQ, but at the average member level, the maximum drawdown is 38%. So that's a heck of a lot of churn and rotation under the surface, much more so than in the case of the S&P 500. And it's manifested itself in other ways, too. You can see the stat I was talking about. It's only 15% for the S&P, but another way it's manifested itself is there's right now I think it's a 32 percentage point difference in terms of the share of the S&P above its 200-day moving average versus the share of the NASDAQ. It's 41 for the NASDAQ, 72 for the S&P, at least through last night's close. For what it's worth, similarly wide spreads of weaker breadth for the NASDAQ looking ahead tends to be more supportive of the NASDAQ in relative returns versus the S&P.
You feel pretty good overall about where the markets are here heading into the second half?
Depends on what you mean by the markets. I think there's opportunities being created at the individual stock level because of how much weaker breadth has been for the average stock. I would be surprised to see some consolidation and a bit of convergence where you continue to maybe see short periods of time, even extended periods of time like we saw in the past week, where some of the high flyers give back a little performance and you start to see whether you measure it by equal weight or just look at average members, look at traditional advanced decline ratios where you start to see some grinding higher down outside of those mega cap names. And I think that would correct some of the concentration problem in a more benign way than if the market just sort of dropped like a stone all at once.
Even if we broaden out, to a much less concentrated environment, you still think people should stay large cap?
Not necessarily. I think they should stay high quality. Now, on factors, quality-oriented factors that we've been focused on, things like strong balance sheet and strong free cash flow and high interest coverage, there is a bias up the cap spectrum there. But even in the small cap indexes, there is a huge performance differential using kind of a quality demarcation. In fact, if you look at the Russell 2000, you go back to the beginning of 2023, encapsulating the period of aggressive monetary policy on the upside by the Fed. Obviously, there's a measure of interest rate sensitivity, which is greater for the so-called zombie companies, those that don't have sufficient cash flow to pay interest on their debt. And if you go back to the beginning of 2023, the zombie companies within the Russell 2000 are down about 10%. The non-zombie companies are up about 10%. So that's a 20 percentage point difference. And I think that's the way to think about it, as opposed to just simply a cap bias. It's the quality, it's the strength of balance sheet, it's the interest coverage that matters, and it matters up the cap spectrum and down the cap spectrum.